Hi, I'm Jenny Regal with the SEC Small Business Advocacy Team, and I'm thrilled to be joined here today to moderate a discussion on reassessing the small public company framework. So, you guys just finished a very insightful discussion on the IPO on ramp, and we're here to talk about the next step in the process on being a public company. Um, we often hear from small public companies on how the IP or the being public can be costly and daunting and the costs that are associated. So we wanted to spend the next few minutes discussing kind of what are the ways to reassess this public company framework, and where can we go from here. So thank you so much for joining me today. I'll let the panelists introduce themselves, sharing a little bit about who you are and how your work relates to the public company framework. I'll start off with Dan.
Sure. Dan Zinn. I'm the General Counsel and Chief of Staff at OTC Markets. We operate trading markets for over 12,000 publicly traded companies, over 3,000 that are US based. So a discussion on small public companies and what we can do to improve their experience is really our day-to-day business. So very happy to be here. Thank you so much for the invite.
I'm Melanie Neary. I'm a partner at Gibson Dunn in San Francisco, and my practice focuses largely on capital markets and securities regulation and corporate governance. And I work with both public companies and investors, largely in the life sciences space, and many of whom fall under the smaller reporting company framework. So happy to be here today and to chat with all of you about the framework.
Hi, everyone. My name is Una Choi. I am Senior Vice President and Global Head of Regulatory Operations at NASDAQ. I have a unique responsibility of managing our global listing qualification program, both for the US and in Europe. And as part of that, we get to hear from over 4,000 issuers who are listed with our exchanges and have received a lot of great feedback about this topic in particular. So very happy to be able to share their perspectives and views in addition to our own as a regulator and with our mission founded on capital formation, investor protection, and maintaining efficient and orderly markets. At a personal level, I've been part of the capital markets ecosystem for about 30 years and have represented issuers and underwriters at a law firm, have been with an investment bank, and have also been with global companies working on M&A, venture capital, and securities offerings. So it's a privilege to be here.
Hi, I'm Brad Goldberg. I'm a partner at Cooley. I co-head our firm's corporate governance and securities regulation practice. I spend all my time preparing companies to go public and then representing them as public companies post-IPO. People that know me know that I like to get into the weeds, and I also have some fairly strong opinions, so I'm excited to dig into some of these rules and discuss how they might be improved.
And I'm Jennifer Zapralka. I'm a partner at Mayer Brown here in DC, in the capital markets group with a focus on advising public companies of all sizes with their compliance with SEC requirements. And prior to that, I was the office chief in the Office of Small Business Policy here in the Division of Corporation Finance at the SEC. So I've spent many years thinking about the issues facing smaller reporting companies as they are dealing with SEC regulation.
Well, excellent. I'm looking forward to hearing those opinions and thoughts and feedback. I'm going to kick it off with the overarching question here, which is what improvements should we be considering to support companies, public companies, particularly smaller companies, to stay public? Now, I know there are other market forces at play that are really outside of the SEC's hands. So since we're here at the SEC, I would love to focus on kind of those general regulatory concerns. Now, to help organize our discussion, because this is quite the big question, I'd like to kind of break it into three different categories, looking at disclosure and financial statements, then turning to categories and filer status, and ending with filing requirements. Una, I know a lot of people have thoughts on this, but I'd love for you to kick off the discussion on disclosure and financial statements.
Thank you. So as part of sort of our overarching policy advocacy work at NASDAQ, we did, in fact, get feedback and did surveys with our issuers to talk about what is your public company experience like and what can be improved from that perspective. And so we issued a comprehensive capital formation white paper earlier this year, and has a lot of different sort of specific recommendations on it, and I'll cover some of that today. But when we take a look at sort of the feedback that we have received, I would probably bucket them into 4 high-level categories and themes that are coming out of it. One is that disclosure should be based on materiality. Materiality with respect to the business and the financial condition of the company, and that should be the North Star for the SEC's regulations and what the company should have to provide. And that is important not just for issuers, but also for investors, because investors find immaterial information to be unwieldy, unhelpful, and ultimately confusing in terms of how they should be thinking about the company's securities and how they should be making their investment and voting decisions. So that's really theme number 1. Theme number 2 is related to scaled disclosure or tailored disclosure requirements, meaning that there are different sized companies out there, and there are different industries, and there's different life cycles and revenue models and business models that are associated with public companies. So how can we better tailor the specific disclosure requirements to fit the type of company that exists and provide the important disclosure information for the investors? So I know we're going to talk about filer status later, but one is related to just pure quantitative metrics associated with companies, whether it's market cap, revenues, or others. But there are also different industry groups like life sciences and biotech companies that have a very, very different revenue model from other types of companies and manufacturers in particular. There are also community banks that have a very specific needs and provide services to a very sort of specific customers, and they have their constituents, and they have their own set of regulations that they have to abide by. So the scalability and the tailoring of regulations was an important theme coming out of these discussions. The third is cost benefit analysis, and I know that the commission thinks a lot about that, but I do think that there is an impression that the actual costs of the fees and the burden to operationalize the disclosure machine, which is some of the rules that have come in the past, like cybersecurity and climate disclosure. There is a thought that maybe the cost benefit analysis could have gone more into obtaining information about what is truly affecting the issuers to be able to operationalize the disclosure requirements. And then last is concern about regulatory whiplash. So there is, a real concern that, politics aside, with different leadership at the SEC, the guidance and the rules just kind of swing back and forth without sort of stability in terms of what the companies and investors can expect out of the disclosure obligations. So with that in mind, some of the very specific recommendations and proposals and ideas that we have come up with this feedback, but also really anchoring them in the sort of our core mission of investor protection, is related to thinking about the emerging growth company phase and period, and thinking about that and expanding it to just solid 5 years, and then having revenues and convertible debt offerings and other characteristics and triggers come in for the second 5 years. So really giving companies that ability to breathe within those 5 years with the benefits. Second is harmonizing smaller reporting company and accelerated filer definitions so that there is, clear understanding of where that threshold fits between the two. Third is, of course, with respect to accelerated filers in particular, and the large accelerated filers. I mean, when you have the same requirements for a $700 million public float company and a trillion, multi-trillion dollar or trillion plus, public company, that doesn't seem like that scaling is working and probably should be recalibrated in some shape or form. And then, of course, WICSI eligibility requirements and thinking about, gosh, should there be more credit given to issuers that have been able to engage in successful offerings? Should it just be non-convertible security or non-convertible debt, or should it include equities and other sort of requirements to show that seasoning? And then in terms of very specific disclosure requirements, I think we can go broad and very, very specific. Um, and I think we can talk about things related to proxy, and proposals related to that, and sort of the burdens that companies have, both in terms of the actual disclosure related, but interacting with shareholders who come up with proposals, and areas that create distraction for the companies and cost for the companies, especially with intermediaries and OBO designation. And I think there's some work that can be done with that area. Um, Executive comp disclosure, the one that we hear about quite a bit is actually with respect to pay versus performance and compensation actually paid, and whether that is really needed for investors to understand executive compensation of the company. And that information, seems to be already provided in the summary comp table. And another piece of that specific disclosure is that, for that one tabular disclosure, companies actually have to outsource the calculations to a third party. And because it's so complicated. So from a cost benefit perspective, what is the cost that the companies have to take on to be able to generate that disclosure versus the benefit that we are providing to the investors to be able to do that? Um, SK, risk factors, maybe shortening that to be more specific, and thinking about creative ways for companies to be able to put on their website more macroeconomic or generalized industry risk factors, so that the filings themselves are not overrun with extra disclosure. And I think there's different ways of thinking about that. And perhaps thinking about the preliminary proxy statement requirements, and really limiting that to specific mergers or contests or significant extraordinary transactions and proposals that the shareholders have to think about. Um, I can go on and on, but I'll just do one more, just something as simple as Section 16 reporting, the 2-day business requirement reporting. Maybe we can give grace periods and catch-up reporting for things like vesting of the restricted stock, or, compensation stock awards, so that there is a little bit of reprieve from all the things that public companies have to do. So I'll stop there and allow other people to talk about their recommendations.
I mean, I'm happy to jump in. You you covered a lot of great points. I think maybe we should start with filer status. Um, I think you need a PhD or something to understand how you move across SRC, accelerated filer, large accelerated filer. We put together a flow chart, I think it was last year, that we thought would be helpful for everyone to kind of navigate it. I didn't realize what we were getting ourselves into when we endeavored on that. I would remember on a Saturday walking my dog and talking to somebody at the firm as we went through the 80% tests and all of this stuff. And he explained to me why I had no idea what it was actually saying. Um, and then we identified that there was a gap and that needed to be addressed. And we reached out to the SEC, who acknowledged that there was, oh, wait, yeah, it's not quite clear. And we heard back and got the answer. But all that's to say is it shouldn't be that difficult to figure out what status you're in. Um, I have had some involvement with the Society of Corporate Governance. They're in the process of preparing something similar to what NASDAQ has put together, but a letter to the SEC with some suggestions on how we could streamline the filer status thresholds, and also addressing some of these other rule-based questions. But on the filer status, the proposal essentially is to do a couple of things. One, make them market cap and revenue based at a much higher threshold. The original thresholds were set, I think, in 2005 and haven't changed since then. The society did some work and some data analysis and determined that if you move large accelerated filer status up to a $2 billion market cap and a 1.235 revenue based on the EGC test, that you'll capture essentially 17% of what would be large accelerated filers in today's market, which equates roughly to the same percentage that was that Commissioner Ueda mentioned that was in existence at 2005. And so that's 700 million up all the way to 2 billion. The other thing would be to eliminate the accelerated filer status completely. The only thing that being an accelerated filer gets you essentially is a little bit more extra time on your 10K, the 60 days. But it also has this draconian impact that you can be an SRC and an accelerated filer and then have to do the auditor attestation. So I think that's something that could be streamlined for sure. And then the concepts on the revenue and the market cap would be, instead of looking at the end of the second quarter, you wait until the end of the year, you look at where you are. If you cross the thresholds, you don't actually opt in right away. You get a full year and then you look at it again. If you've gone below, then you're back out again and you test the next year. And if you're still above, then you start reporting in that next year. I think that's some of the ways we could deal with a lot of the complexity, especially on the moving in and out of the SRC status. So essentially it would be a non-accelerated filer SRC group and a large accelerated filer group. I think that would go a long way towards making some of this a little bit less complicated and easier for issuers to understand and navigate.
I like that. And you would do revenue and market cap, correct? It's not an or?
It would be revenue and market cap to move up, and then if you're down on either or, you would move down.
Yeah. Okay, got it. Yeah, because I see, especially in the life sciences space, it's the market cap. Most of them don't have revenue, who I'm working with, but market cap, with the markets being so volatile, they're in, they're out, they're in, they're out. And then what are we even trying to comply with? And as we've touched on many times earlier now, like the costs associated with being the large accelerated filer are significant. So having that certainty of I'm in this bucket for as long as I have no revenue or revenue below 2 billion, I think would go a really long way.
Yeah. I mean, in the category of great minds think alike, I mean, that was exactly sort of how we were thinking about it too, in terms of not just raising the market cap, but really having some kind of a revenue or gross profit or some kind of financial metric that ties into that maturity, that life cycle of a company. And I do biotechs in particular have that issue, and they actually have that issue sometimes with the other filer categorization as well, because they might just have that revenue come in because of a milestone payment, but then they don't have a recurring revenue quite yet. So I think thinking about it from that perspective, and that's why we thought, expanding out the emerging growth company requirements and harmonizing the smaller reporting company requirement with accelerated filer requirements would really help those type of companies that may have one-off, good thing in terms of money coming in, but triggers and has unintended consequences because they had one milestone payment or some other event that occurred, but that's not recurring.
That's a really, really good point. For those one-off payments. And realistically, their businesses aren't changing. So why should the disclosure need to change so significantly for that 1 year?
Yeah.
I'm going to pull us back and going to make it so you only have to ask one question this whole time. We'll just take it from there. But I want to pull it back into disclosures because I think there's so much ground to cover there. And excellent points that NASDAQ raised in the white paper, and that I think are relevant to a lot of the public company experience. As I'm seeing my role as the different perspective here, but specific to smaller companies, there are scaled disclosure requirements that apply. And to give the SEC credit for all the work that they've done in 2021, when effective changes to Rule 15C211, which does not roll off the tongue, but is a very impactful rule that sets forth disclosure requirements for companies that are not necessarily listed on an exchange. So from the OTC perspective, it includes things like SEC reporting and all of the issues attendant to that you've gone over, but also allows for an enumerated list of material information that becomes the basis for ongoing disclosure on an annual and quarterly basis that companies on our markets can use to reduce the cost, reduce the complexity a bit, and focus really, to, I think, everybody's point, on what's actually important to investors. So thinking about ways to highlight something like Rule 15c211 disclosure. Una mentioned community banks. We have hundreds of community banks, and we have a bank standard disclosure based on what they're already doing for their regulatory requirements to begin with. And just scaling that a little bit with what's expected in terms of financial disclosure of a public company, and then allowing them to access the markets. And as you know, for a lot of the community banks, they're really focused on their community. The community bank in Pennsylvania is not so worried about the Oregon investor, right? They want to make sure that they're providing enough access to the folks that are really their depositors and they're in that area. So there are ways that already exist to scale disclosure, and maybe can even present an example for some of the modifications that we're talking about here.
So what I'm hearing is sort of, it's a combination of tailoring and scaling, right? So it's like the tailoring is more, and it all comes back to what do investors really need to know about these companies. But tailoring would be sort of across the board, not necessarily just for the smallest companies, but focusing in on these are the relevant 10 things, 20 things that investors really need to know about life sciences companies, about biotechs, about, you name it. But then the scaling, which, as I agree, the Commission has lots of scaled rules already for smaller reporting companies. There were some that could probably be scaled further. Pay versus performance is scaled. It's not perfect, but they tried. And I have thoughts about exec comp as well. It is. They still have to do the compensation actually paid.
For the EGC.
They don't do it at all.
Right.
Yeah.
Right.
But I just the trick for the regulators, or the challenge for the regulators here, is scaling well, but not taking away what investors are going to need, and they don't always know that up front, right, as they're drafting the rules. So it's sort of are we looking at a retrospective? Are we revisiting rules that have some scaling but not enough, or no scaling at all, and trying to figure out what do investors really want here? And is there a way that maybe more of these requirements can be principles-based, so that those smaller companies can say, this is relevant to me here, here, and here, but not there, so I'm only going to address what is relevant to my business, my company, what my investors need. Now, again, while we're talking about challenges for the regulators, that you lose comparability there. It makes it harder to compare for investors to compare those companies against each other. But I think you can come up with some overarching principles that are based on investor requirements, and it can be very helpful.
Well, one on scaling, I guess in my word, scaling meant eliminate. So but on the comparability, I do think that is something that gets discussed, and it's a fair point. But I also think with the number of rules that the companies have to address, what you ultimately often see is boilerplate disclosure, and everybody's kind of saying the same thing. And so I don't actually think you're getting that much information, and it's not servicing the real intent, I don't think, behind the rule, because you have everybody just sort of going down to the lowest common denominator and looking at everyone's disclosure, and it's not really telling you much. So I do think that's an issue. And it goes back to your point about focusing on materiality and getting back to what are the important things that an investor needs to know about a company, and not having the special interests and the political aspects and the social issues, wind their way into the disclosure and have a kind of regulation by disclosure mechanism. I think there are other ways to address those. And I guess I sound like Commissioner Pierce, but I do think it's a really good point, and that there are other ways to address those things while making sure that investors are getting the material information.
Yeah.
So it's not often that we have, 5 securities lawyers thinking about ways to look at policy. Can we dive in more on kind of when we talk about materiality and when we talk, and we've given a number of specifics, which is fantastic because, when I go back and when I was in CorpFin and had my rule writing hat on, it's helpful to have ideas and thoughts when you're looking at what is happening in the world and where can we go with this. It's helpful to have ideas and suggestions. And, as a small business advocacy office, it's helpful to know kind of where people's thresholds are and where the line is. So I'd love to hear, are there other suggestions and ideas? I know we've delved into a lot, and Una, you started with a very long list, which was phenomenal. But are there other ideas or other areas that we haven't covered kind of on the disclosure and financial statement piece that you would want to talk about now?
I mean, I'm happy to go. um, Realizing that I'm cannibalizing probably some of my own existence, I do think another area that could be addressed is the quarterly reporting, and the 10Q requirements. Um, Looking at whether it could go to more of an FPI model and you're doing something semi-annually or not even at all, because quite frankly, the earnings release is really what everyone is focused on. That's where the financial information for the quarter is. There's not that much in a Q that tends to really move anyone's needle as far as materiality or investor. I'm not sure they pay that much attention to the Q, quite honestly. But it's a significant amount of work for the company to do on a quarterly basis. So I think that's at least something worth looking at. Is there something that could be done there? Una mentioned Section 16. I can't tell you the amount of hours that have been taken up in my brain by looking at whether a GRAT or a trust or a this or that, requires a Form 4 in a 2 business day window. That really, I don't think is material. So I think there's a way that we could probably look at addressing some of those issues, and maybe it's again reported on the next Form 4 and not on a short fuse. Could we eliminate Rule 144 filings for the smaller companies? Those are a bit of a headache, especially now that they need to be filed on the same day. I don't know, other people probably have other suggestions as well.
The 10Q and the sort of the semi-annual reporting regime is something that we do hear about quite a bit. And I do agree. I mean, if you have a quarterly earnings release that's already published, has a lot of really important information, then you can couple that with an 8K to get the important material information out to the investors on a timely basis. So that is something that I do think that the commission should really think seriously about. I know it comes up in different conversations, and I do think that it'll have a practical impact for companies, and it'll still provide robust and necessary information for the investors as well.
Yeah, I think it would need to be coupled with an 8K for
Exactly.
securities offering
Yeah.
matters, but I do think there's a creative solution to that gets rid of kind of, especially in May, repeating so much of what you just put out,
Yeah.
Oftentimes 6 or 8 weeks prior.
Yeah.
Will they change?
Speaking of 8K, I promised my partner that I would bring this up, but the kind of draconian result if you miss an 8K or certain 8Ks that put you in a penalty box for 12 months and not able to use short form S3 to sell securities. I think that's something that should be looked at. The fact that you forgot to disclose your frequency of what you decided on your say on pay vote means that you can't use an S3 for, I'm not sure makes a ton of sense to me. And so maybe looking at, is it just all go to not timely but currency, or what?
Or expand the list
expand the
of
safe
the
harbors.
safe harbors, or have the staff be more transparent about the waiver process,
Willing to wait.
because that is a black box. You don't know how many waivers they're granting. You can't see what sort of arguments are made. As a practitioner, if you're looking to help your client at requesting a waiver of S3 eligibility, it's you're starting from scratch every time.
Yeah.
So all of that could be useful.
Yeah.
The other one I promised I would mention is XBRL tagging. The fact that you might have missed tagging your equity grant policy language in your proxy, somehow means that you now can't file an S3. Also, I don't think makes a ton of sense. And I'm not even sure that was really the intent, but maybe it was. But I think it's worth looking at that as well. Those seem to be fairly draconian results.
Along that line, also just thinking about XBRL for the smaller companies. Is it really necessary for the very smallest companies to be having the expense of XBRL tagging? Are the analysts using it?
Totally. And I see the most issues with those smaller companies. XBRL tagging requiring amendments and extra cost to fix the problems that originally came up. And again, like, to what end?
Yeah, I'll just point out again that there are scaled in our market requirements for things like 8K. We call it a current event report, but a 4-day window with a more well-defined list of what needs to be disclosed there provides an opportunity for, again, smaller companies. And I will dive really, really into a very specific point that I think Una raised earlier with respect to OBOs, to objecting beneficial owners, and how that ties into Section 16 requirements, and maybe go in a slightly different direction. But it is so valuable for companies to understand who their investors are. And the fact that OBO requirements don't necessarily carve out insiders and affiliates of the company. If you can build up a position in a company as an OBO, and particularly, again, in the OTC market, if you can do that without disclosure, that creates the wrong incentive and the wrong information flow for investors. So maybe looking at the OBO requirements as a whole, and how shareholders overall are required to report their existence, and coupling that with some investor protection related policies around insiders would I think, be really impactful.
Absolutely. I mean, I think proxy, plumbing, access, shareholder proposal, that could probably be should be a roundtable on its own. But I do think that that's such an important part of the public company experience. And there's a lot of work to be done there. And there is a lot of costs that are associated with the proxy process, and costs for issuers related to areas where they do not have control over which intermediaries they get to pick, and also the result and the benefit is that, or the lack of benefit is that most of the times the shareholders are not engaging with the companies and vice versa, because there's no direct link. And I understand sort of the confidentiality and things of that, concerns that are held at the broker-dealer level and at the account level. But I do think that this is an area that is really due for a fresh look and review, especially in the context of some of the AI and different technology initiatives that we have, that are being developed. Another area that, just even as mundane as the exhibits list, I mean, the amount of time that in-house counsel, poor associates at a law firm have to spend to update and things of that nature. I mean, I feel like that could be something that could be refreshed perhaps on a company website, as opposed to on a filing, but have some kind of a jurisdictional reach for the, accuracy of that information. So maybe there's creative ways to think about how those type of administrative disclosure could be worked into areas that are outside of maybe the filing requirements, but perhaps housed somewhere else by the companies, so that it's easier to manipulate and update and just provide information more on a real-time basis.
Yes, just to underscore that, I know, because we've looked into it a bit, that the rules relating to the OBO and NOBO designations, they're 50 plus years old.
I know.
The reasoning behind why that system developed no longer really carries any weight.
Absolutely.
And so taking a fresh look at things like that now, with a commission that seems inclined to do that, which is wonderful. It's all about prioritizing all of these wonderful ideas, I know, but that really should be closer to the top of the list than I think most people expect.
Yeah, like what about the broker search?
Yeah.
Oh,
right.
yes.
I mean,
And again, for smaller companies, that cost is real. Yeah.
if you ask Broadridge, they can run it in a day,
Yeah.
right? The rule was meant because you needed to actually mail out things and give time for them to come back. They don't use that process anymore. And it actually does have some practical real world impact. I've got a client looking to do a special meeting and want to do it quickly, but we have to build in this, it's basically meaningless period of time to run the broker search when it's not required, in order for them to get the information they need.
Yeah.
I'll also make a plug to get rid of the annual report and just use the 10K.
preliminary proxies, as we talked about. I think other than for really important sort of shareholders meetings, there's probably not much of a need for that. And I know that the staff probably doesn't look at, I mean, probably sort of a, how should I say, sampling, right, of the review. So that's an area that probably could be streamlined, both for the companies as well as for the staff as well, reduce the burden.
And state law provides a good model there for some of the non-SEC registered companies that trade with us. It's Delaware law or whatever their state of incorporation is. And it is an easier to understand and often more efficient process.
So many excellent ideas. Before I pivot and kind of talk about S3 and registered equity offerings, do we have any other thoughts? I don't want to cut off the conversation, but I do want to keep moving.
I mean, I would just say I don't think there have been a lot of favorable and helpful changes over the years. You know, the business section being more principles based. What else? I mean, there's a number of things. The CNDIs now being blacklined, where you can see the changes instead of when they came in, and somebody, you know, I'd be shuffling around my office looking for the old CNDIs that I had printed out so I could copy them, you know, and then run a black line for myself and then send it out to the group so we could understand what the changes were. I mean, so I do think the staff in the commission are looking at these things and have been amenable. So I don't want to be, you know, the doomsayer here. I just think there are some other things that we could continue to do that have been around for a long time that I think could use some updating that would actually make some real difference to some of these companies.
Totally agree.
Absolutely. Okay, so I'm going to switch on. So one thing that we often hear from small public companies is the reason to go public is to be able to tap the public markets, right? And I'm sure with life sciences, you see that a lot, right? Being able to go out and raise capital. But when we looked at the data, small public companies, only 13% of them raised a registered equity offering in the 12 months ended June 30, 2024. So a very small percent is actually going out and raising that capital in the public markets. So I'd love to hear from you. What are your ideas? Like, how can we look at changing registered offerings to open up the market and be able to allow that pathway? And would that encourage more small public companies to stay public?
I'm happy to start.
Yeah.
So in our earlier panel, we talked about both making an IPO more attractive, but also having benefits to being public. And I think this is a great area. We can look into that. And I think two ideas I'd love to recommend to the staff to look into, one of which is to re-examine the need to wait for 12 months and to have a 10K filed to be S3 eligible. It's not stopping companies from raising money, but it's costing them much more, either by using the S1 process or by doing a PIPE and then registering the shares on an S1. And what I hear from clients all the time is the desire to be able to do at-the-market offerings and to dribble out securities, particularly when markets are more volatile, at times where there is an opportunistic stock price. And they can't not do that on an S1 currently. So by having access to S3, they could start kind of filling their coffers after the IPO. So I think that's one. The second, which we have seen a lot of lately, is the baby shelf rules. And besides being somewhat complicated for companies to understand, that $75 million threshold ends up being relatively high, but the 1/3 ends up being quite low, especially when ATMs are counting against that, anything registered on the PROSEP. And really, these are the companies that need the money the most, and the market's going to tell them if they can't raise. So I think looking at, does it make sense to lower that $75 million to something less, and or raising the 1/3 threshold to something that actually gives them the ability to raise money and have runway out of baby shelf rules, because you're not really able to raise enough to get out of the $75 million public float. And I think the both of those would really give companies the ammunition to tap the public markets like they intend to.
Can I just high five on that and make that my commentary? I agree 100% on continued access to capital, and specifically the ideas that you raised. I would add only that, again, Regulation A, which I think we talked about a little bit on our last panel, is another option for that, particularly for smaller companies where that $75 million limit can be impactful. Yeah. It actually can be more impactful than the baby shelf rules allow for it at this point. But yet another opportunity for companies to engage. Right now, Regulation A has a specific prohibition against at-the-market offerings. So I'd love to see the Commission go back and reconsider how they can change that and open up these pathways, in a number of different ways. That not only would keep companies public, I think it would provide the impetus for some companies to go public in the first place. What we see now, and these are wonderful ideas, the kind of existing problems that they can address. We see companies, and I think we talked about this a little bit, entering into convertible equity offerings, or they take on what we call a death spiral financing because they don't necessarily have another better capital raising option. And they're issuing equity to somebody that they may or may not have had a pre-existing relationship with, who is just going to exercise at a discount to the then prevailing market price, bringing down the experience for their existing public investors, bringing down the company on its way and its cap table. And so, again, it's wonderful to talk about ways to allow companies to raise more money, but it's also addressing some very specific problems that are impacting both companies and investors now.
I completely agree. Everything you said about S3 and the baby shelf is like exactly what's on my note card. When the rule was adopted, I think the idea was, sort of capping it would keep. There was a worry that the thinly traded securities would be subject to more manipulation, so they're just sort of putting a limit on it there. And there was also a concern about the information not being disseminated. And I think you made the point that the market's not going to take these securities if it's not going to work. And then there's so much more information flow now than there was. I mean, it's a completely different information era than we were dealing with in the early 2000s. So I think definitely ripe to reevaluate the baby shelf rules. And along with that, as you say about Reg A, can't do ATMs, can't do something can't do delayed offerings, period. So that's, and there are reasons for, and not every issuer probably in the Reg A world should be doing that, but I think that there are ways to look at those rules and explore if that would give them more runway.
Yeah, look, the market will speak as well for Reg A issuers. And I know you know better than I do, but I know from the initial drafting of Regulation A that the idea was, let's prevent it for now. Let's see what happens with these companies, and then re-examine. And I've heard Chair Atkins and then Acting Chair Ueda say similar things about taking a look at these rules. So I think it's moving in the right direction.
Excellent. Anything else before we close it out with our ultimate question of what is the most impactful change? I mean, mine are cool. Yeah. So we've talked about so many different ideas. I would love for everyone to kind of step back and think about what could be the one most impactful change that you think that would help smaller public companies? I guess I'll kick it off with Dan.
Oh, man. Everyone will pick up whatever I miss, I'm sure, so it's okay. But I'm going to stick with the theme that we were just on. I think the ability to continue to raise capital while being a public company, it's one of the biggest things that we hear from the companies that are on our markets. If we have, let's say, 500 or so US-based companies on our OTCQX and OTCQB markets with a $150 million market cap, let's say, on average, right? Those companies have very specific capital raising needs that are addressed in some of the negative ways that I talked about before when there's no other option. So really giving these pathways, whether it's through registered offerings and baby shelf rules, whether it's through Regulation A, will probably have the most impact.
Yeah, I concur. And I think your point about the kind of terrible convertible financings, the issue is they take up so much of the cap table that it doesn't help the public float problem, and it just drives them further and further down from 75 million. So by re-examining that and having access to capital more easily as a newly public company or a struggling public company, I think would keep companies public for longer as well.
So many, but just updating the filer status thresholds and requirements in the context of the current economy, in the context of the type of businesses that we have in our public markets, I think is going to be an important one. And I think it's, and that ties into, of course, the North Star of materiality being at the core of any disclosure requirement. Cost benefit analysis, I think, is going to be a really important one because to me, especially for small businesses, when you have one or two people trying to put these, disclosures together and you're operationalizing it, that's a really big challenge. And I hear from general counsels and securities counsels a lot in terms of, I don't know how I'm going to do this with the two people that I have on my team. So.
Well, you can hire us, but I agree on the scaling. I mean, on the thresholds. I also think expanding the scaling and harmonizing the SRC and EGC stuff would be super helpful. And I'll make my final plug that I also think we need to address the shadow regulator out there, the proxy advisory firms that have an outsized influence on the companies and the conflicts of interest that come from that. And I do think that's also something that is hindering, or at least in people's minds when they're thinking about going public.
Yeah, nothing new beyond those. I don't think. I think probably number one for me is the access to the public markets for additional capital after a company has gone through the IPO process, as we've talked about, and the filer status. Sort of right sizing that, aligning them appropriately, which has to be done with caution because a big part of this that we didn't talk about is 404B and who stays in that bucket of needing to do the auditor attestation, which the regulators will need to move cautiously there. But I think that you could really sort of streamline, and it ties into that scaling idea of getting the right information out there that investors need. So
Thank you all. This has been an absolute pleasure to join you, Dan, Melanie, Una, Brad, Jennifer. This has been a wonderful conversation thinking about how we can reassess the public company framework and what we need to be thinking about as, to encourage those small companies to stay public and to keep our markets healthy. So thank you again for joining me. And yes.
Thank you.
Thank you.
Thank you.